Something just broke in Japan, and almost nobody is paying attention. But this one event has the power to shake your stocks, your savings, your home value, and even crypto in the next few months. In January 2026, Japan's long-term bond yields jumped to levels not seen in 3 decades. That alone is historic. But what happened next is what should make you stop scrolling. The U.S. Federal Reserve stepped in to stabilize Japan's currency. Think about that. America's central bank is now using its power to support another nation's financial system. That's not routine cooperation. That's emergency containment. Why? Because the structure holding global markets together for 30 years is cracking. And when that structure fails, money doesn't politely move, it rushes for the exits. What looks like a technical bond story in Tokyo is actually the trigger for a massive unwind that could force trillions of dollars out of U.S. stocks, bonds, real estate, and crypto. This isn't about panic. It's about physics. Leverage has rules. Debt has limits. And when those limits are crossed, the system reprices fast. Over the next 12 minutes, you'll see what's breaking, why it can't be stopped, and how to avoid being on the wrong side of it. For 3 decades, Japan lived in a financial universe unlike any other. While the rest of the world dealt with normal interest rates, Japan's rates hovered near zero. Money there was essentially free. That made Japan the engine room of global finance. In late 2025, that changed. Japan's central bank lifted rates to their highest level in 30 years and abandoned the policy that had capped long-term bond yields. The moment that safety net disappeared, the bond market reacted violently. Long-term yields surged at a speed bond traders describe as statistically impossible. This wasn't a gradual adjustment, it was a snap. Japan carries a debt load more than twice the size of its entire economy. For years, that debt was manageable because servicing it cost almost nothing. But when rates rise, even slightly, the math flips. Every percentage point adds enormous pressure to a system built on cheap money. Bond prices began to fall. Yields spiked. And suddenly, the foundation of Japan's financial model looked unstable. That instability didn't stay in Tokyo. Currencies moved, capital shifted, the yen weakened sharply. And that's when Washington stepped in. Not because it wanted to help Japan, but because what happens in Japan doesn't stay in Japan anymore. The world's markets are woven together, and when one pillar moves, the entire structure feels it. You might be thinking, I don't own Japanese bonds, why should I care? The answer is simple. Japan's money has been propping up your market for years. Behind the scenes, Japanese institutions became some of the largest buyers of U.S. government debt. Banks, insurers, and pension funds in Japan sent enormous amounts of capital into American bonds. Over time, that flow became a pillar of the U.S. financial system. This wasn't charity, it was a trade. Borrow cheaply in Japan, convert to dollars, buy higher-yielding U.S. assets, collect the difference. Repeat. For decades, this trade looked like free money. It lowered borrowing costs in America, boosted stock valuations, and made risk feel safe. Now that trade no longer works. When yields in Japan rise, the incentive flips. Capital stops flowing outward. It starts coming home. That reversal forces selling. Not someday, mechanically. Funds unwind positions. Banks rebalance. Institutions reduce exposure. And here's the critical part. When large investors need cash, they don't sell carefully. They sell whatever is liquid. That means U.S. bonds, U.S. stocks, index funds, tech shares, crypto, anything that can be converted to cash quickly. The pressure doesn't stay in one asset class, it spreads. That's how a distant bond move becomes a domestic market event, and once it starts, it feeds on itself. To understand what's breaking, you have to understand the machine that powered the last 30 years of growth. It was called the carry trade. Investors borrowed in currencies with ultra-low interest rates, mainly the Japanese yen, then converted that money into higher-yielding assets abroad. The U.S. was the prime destination. American bonds paid more. American stocks grew faster. And for decades, the yen stayed weak and stable. It looked risk-free. If you could borrow at nearly zero and earn 4 or 5% elsewhere, the only limit was how much leverage you dared to use. So institutions multiplied it. 10 times. 20 times. Sometimes more. This quiet engine injected trillions into global markets. It suppressed volatility. It inflated asset prices. It made buy the dip feel like a law of nature. But the carry trade only works under one condition: the funding currency must remain cheap. Japan just removed that condition. When borrowing costs rise at the source, the entire structure becomes unstable. Suddenly, the spread disappears. Currency risk matters. Leverage becomes lethal. Positions that looked safe become toxic. And when that happens, there is only one move left: unwind. That unwind is not philosophical. It is contractual. Margin calls don't ask for opinions. They demand action. That's why this isn't about sentiment. It's about mechanics. What makes this dangerous isn't the visible money. It's the invisible leverage sitting beneath it. Japanese institutions officially hold over $1 trillion in U.S. government bonds. But that's just the surface. Hedge funds and global banks copied the same trade and magnified it. They borrowed cheaply, converted currencies, and piled into higher-yielding assets using massive leverage. Estimates from major financial institutions suggest that the total exposure tied to this strategy ranges between $15 and $20 trillion. That's not a typo. This isn't a single fund. It's a system-wide behavior embedded into global finance. And now, the math has turned against it. When rates in Japan rise, the funding cost rises. When the yen strengthens, currency losses appear. When either happens, leveraged positions become unstable. Losses expand. Collateral values fall. Lenders demand more margin. And that's when selling begins. Not careful selling. Forced selling. Positions that took years to build are unwound in days. Funds don't choose what to sell. They sell what they can. In August 2024, a small move in Japanese rates triggered a preview. Stocks fell sharply. Crypto collapsed. Trillions vanished in days. That wasn't the event. It was the warning. This time, the move is larger, the system is more leveraged, and the escape routes are narrower. The unwind doesn't wait for permission. It follows rules written in contracts. Here's the uncomfortable truth. Your portfolio is connected to this, whether you like it or not. If you own an index fund, a retirement account, or any growth stock, you are standing in the path of this unwind. Not because those companies are broken, but because liquidity is. When leverage trades begin to fail, funds don't ask, which company is best? They ask, what can I sell right now? And the answer is always the same: the most liquid, most widely held assets. That means large cap U.S. stocks: Apple, Microsoft, Nvidia, Google, Amazon, Meta. These names dominate retirement accounts and ETFs. They are easy to sell in size, and when funds need cash in minutes, not weeks, these are the first to go. This is why crashes feel irrational. Great companies fall alongside weak ones. Fundamentals don't matter in a forced unwind. Only liquidity does. It's also why volatility spikes. One sale triggers another. Prices gap down. Algorithms react. Stops get hit. Momentum flips. What began as a bond issue in Japan becomes a sell-off in Silicon Valley. This isn't a forecast of permanent damage. These companies will survive. But prices don't move on survival. They move on flows. And the flow is about to reverse. That's how a distant rate hike becomes a local market storm. This moment is not asking you to panic. It's asking you to think. Financial history is a cycle of leverage, growth, strain, and reset. We are entering the strain phase. That doesn't mean everything collapses. It means assumptions change. Most investors live inside narratives. Stocks always recover. Bonds are safe. Central banks will fix it. Those stories worked until they didn't. Preparation isn't dramatic. It's quiet. It's reviewing exposure. It's reducing fragility. It's owning assets that don't all depend on the same outcome you don't need to predict the future. You need to be able to survive more than one version of it. The next few months will reveal whether markets can absorb this shift smoothly, or whether they reprice under stress. You can't control that outcome, but you can control whether you're overexposed to a single story. Use this moment to step back. Reassess. Strengthen your structure. Crises don't reward intelligence, they reward readiness, and readiness begins before urgency forces it.